So far, our discussion has been pretty abstract. We have been introducing you to the art of finance and explaining why understanding it is an essential ingredient of financial intelligence. Now let's revisit the issue we posed in the preface, the benefits of financial intelligence. With a little art of finance discussion under your belt, you can understand in greater depth what this book can teach you and what you will gain from reading it. For starters, we want to emphasize that this book is different from other finance books. It doesn't presuppose any financial knowledge, but neither is it another version of Accounting for Dummies. We will never mention debits and credits. We won't ever refer to the general ledger or trial balances. This book is about financial intelligence, or as the subtitle says, knowing what the numbers really mean. It's written not for would-be accountants, but for people in organizations, leaders, managers, employees who need to understand what is happening in their company from a financial perspective and who can use that information to work and manage more effectively. In it, you'll learn how to decipher the financial statements, how to identify potential biases in the numbers, and how to use the information in the statements to do your job better. You'll learn how to calculate ratios. You'll learn about return on investment, ROI, and working capital management, two concepts that you can use to improve your decision-making and impact on the organization. In short, you will boost your financial intelligence. If you boost your financial intelligence, moreover, you will very likely stand out from the crowd. Not long ago, we conducted a national study, giving a 21-question finance exam to a representative sample of non-financial managers in the United States. The questions were all based on concepts that any company executive or junior finance person would know. Unfortunately, the managers scored an average of only 38%, a failing grade by any standard. To judge by their answers, a majority were unable to distinguish profit from cash. Many didn't know the difference between an income statement and a balance sheet. About 70% couldn't pick the correct definition of free cash flow, now the measure of choice for many Wall Street investors. By the time you finish this book, you will know all that material and a good deal more besides. That's what we mean by standing out from the crowd. The benefits of financial intelligence. But it isn't just a matter of scoring well on a test. Financial intelligence brings with it a host of practical benefits. Here's a short list of the advantages you'll gain. Increased ability to critically evaluate your company. Do you really know if your employer has enough cash to make payroll? Do you know how profitable the products or services you work on really are? When it comes to capital expenditure proposals, is the ROI analysis based on solid data? Boost your financial intelligence and you'll gain more insight into questions like these. Or maybe you've had nightmares in which you worked at AIG, Lehman Brothers, or maybe Washington Mutual. Many of the people at those companies had no inkling of the precarious situation. Suppose, for instance, you worked at the big telecommunications company WorldCom, later known as MCI, during the late 1990s. WorldCom's strategy was to grow through acquisition. Trouble was, the company wasn't generating enough cash for the acquisitions it wanted to make, so it used stock as its currency and paid for the companies it acquired partly with WorldCom shares. That meant it absolutely had to keep its share price high, otherwise the acquisitions would be too expensive. And if you want to keep your share price high, you'd better keep your profits high. Moreover, WorldCom paid for the acquisitions through borrowing. A company doing a lot of borrowing also has to keep its profits up. Otherwise, the banks will stop lending it money. So on two fronts, WorldCom was under severe pressure to report high profits. That, of course, was the source of the fraud that was ultimately uncovered. The company artificially boosted profits with a variety of accounting tricks, including understating expenses and treating operating costs as capital expenditures, as Businessweek summarized the Justice Department's indictment. When everybody learned that WorldCom was not as profitable as it had claimed to be, the house of cards came tumbling down. But even if there hadn't been fraud, WorldCom's ability to generate cash was out of step with its growth by acquisition strategy. It could live on borrowing and stock for a while, but not forever. Or look at Tyco International. For a while, Tyco was another big acquirer of companies. In fact, it bought some 600